Hi, I hope you're doing well. I wanted to just quickly show how this valuation template that I made works. I'm actually going to jump into this and show you how it works with what Levi's, I guess I pulled up. So what I have on my screen, I'm just going to work through doing all the data entry and then showing how the mechanics work. This is in no way a stock recommendation. I'm just making it sort of make sense and filling out all the numbers and then showing how the template works so that we can spend our time analyzing the business and not in sort of the crazy word find adjustments to adjustments that overwhelm valuation. So one thing I'll just apologize up front. I don't know if this is going to be tiny font or not. I'm not sure about that. If you're an expert in video and AV stuff, obviously I'd love your help. Give me some pointers. I'm not. I also might go through this Excel slowly, but hopefully it still can be done with someone as slow and as like not technologically inclined as myself that you could crush this. Meaning that we can spend our time analyzing businesses and reading footnotes and understanding that all those real important aspects of valuation, because hopefully the mechanics don't take that long. So with that, let's just get into it. I think I'm going to move this screen and then I'll get started here. So this is what I have. It's my template. And I have over here on my left side of the screen, hopefully you can see this. This is just the information I downloaded directly from the SEC. And there's just the file you can get, the Excel file, obviously. For one of them, Reddit actually didn't have the Excel file, so I was manually typing them. That took me a little bit longer. I didn't want to do a video on that. That would just be, making how silly I am at typing. But this is just my template over here. I'm going to fill it out. I did sort of delete it, so I'm actually more like building off of my blank ones that I have here. These other ones here at the bottom, you can see are already completed. I've done all of them except Levi's. I want to finish off right now. And I wanted to kind of do that together. There's nothing unique or different about Levi's. It just happened to be the last one I did. So here's what I'm going to do. I'm just going to fill this out. I'll try to talk through it. I'm not sure I'm going to be perfect at this. Again, I am not, a tech whiz or AV specialist. But what I did there is I put in revenue. I put in cost of goods sold. I did make some slight changes I'm putting in cost of goods sold, to their income statement just so I made fewer mistakes. And I bolded some things just so I wouldn't miss them because I don't actually have – I'm slow. And so here's what I have on these. This interest expense. So I'm just filling these out. I mean, I'm actually, as you can see, I'm almost done my income statement. I screwed up there. I should have done that just to keep the formatting. It doesn't matter. I could change the formatting later, but I just like to do that. And then this is my total other expense. I'll actually talk about this one in a second. So there's a good example. I did it again. I'm not going to have interest income and other in this situation. Actually, I could. I'll leave it there for now. But I don't have anything historically. I still need my taxes. Where are these? Income tax expense. There it is. Control C, paste. Hopefully you're not bored yet. And I'm done that. Now I want to make sure my income ties out. Sometimes it doesn't. Let me just make this clear for myself so I don't miss it. And actually, when it doesn't, it's usually not a big problem. It's likely just – did I get that right with the income tax expense? No, I didn't. Income tax expense, yes. So I'm slightly off here, but that's fine. That's just because my positives and negatives are wrong. So if I need that to be 249.6, and that's my operating income, let's see. Operating income 353, that's right. So my mistake clearly has to lie with – one of the others. Okay, I think I got it. These I have to enter as, and companies do this differently. So companies do this differently. I don't always know off the top of my head. And is that right? Yes. You can't see it because it's, I can actually make these bigger just in this case because they have small units. I'll just make them bigger. There we go. And then I'll reduce that. I need to just change the sign on these because companies don't always enter them the same way, especially in the other stuff after operations. And all I need to do here to tie these out is just to flip all the signs. There's probably a faster way to do this. You probably are already done, but I'm not. But I got them all done. And importantly, my net income, that one's not right. What mistake did I make there? Income before taxes. Oh, that's interesting. I just didn't actually pull my formula over there. So that's why that one didn't tie out. All right, let's look at it now. What did I do? I just completed the entire income statement for Levi's. And technically, all of my forecasts are done as well. for the income statement. I'll show these now. I'm not thinking about my forecast right now. I'm not debating how much they are, but because I had these as formulas, it's already all tied in. I'll just mention this. You realistically, although they had impairments, I'm not going to assume that's going to continue, or I would just include that in other expenses in different ways. So let's assume that just goes to zero. Again, I'm not debating my assumptions here. This is just pure mechanics right now. I'm not standing behind these and saying this is my actual stock pitch. It's not. These are like possible numbers. There is a scenario where that could happen. These aren't insane. And I'm not debating why I use that tax rate. I just put numbers in to move forward. But I'm done my income statement. I'm going to jump down to my balance sheet. As you see there, I have my discount rate that obviously will affect the valuation, but I'm not debating that for this company. I'm just leaving in my generic stuff. As we go down there, these are the valuation models. This doesn't make sense yet because my financials aren't filled out, so don't worry about these, except I do want you to know I did enter in the number of shares and then the stock price as of today's close. So it is Thursday, April 4th. And that was the stock price of Levi's. Actually, it was up 12% today. And I didn't look at why. So none of this is me analyzing the company. I mean, I will do that, but I didn't do that yet. But I do need my numbers. That's my shares outstanding. That's my stock price. My valuation will compare to that. The valuation right now doesn't mean anything because I don't have assets. It's all set up. So all the formulas are set up to do this. All right, let's jump to this. I got to fill out my balance sheet now. My income statement's done. And importantly, I did check that my income statement tied. My income was correct. So my organization might be slightly different from what they report to, for the SEC, but mine still works out. So let me jump over to the balance sheet. I got to make this a little bigger. I can do it this way, actually. Let me see what I got there. Okay. So I got to copy all this stuff over. Same thing. I'm going to copy paste. I'm going to throw these in as needed. I only have 2 years. That's fine. So that would be the 2 most recent years, just to be clear, not the first year. If you want to go ahead and fill out the first year for some of these companies, please do. I'm just showing the minimum that I need here, but you're welcome to do whatever you want. I'm going to skip short-term investments. I'll tell you why in a second. That's going to be a financial asset, but I want to continue to populate these. The specific labels here in my generic stuff in the blank spreadsheet, I just call it like asset 1, asset 2, asset 3. So you can call these whatever you want. Here's a good example. This is actually not, I have prepaid expenses and other, but that's not what this is. So I'll just change that. This is other. Actually, I didn't need to do that. Sorry, I could just delete that. I can put that here because I had it there. So then I just don't need this one anymore. And I'll leave it there. I'm not trying to change my, I would actually recommend, just to make this work, I would hide the row. I wouldn't delete it. It probably would still work, but I don't want to. I'd rather just do that. Okay, I did my current assets. Now I need to go to my current liabilities. It almost doesn't really matter how I organize these other than being complete. And the main reason for that is that the specifics of the organization don't matter as long as I have everything here. The specific labels don't matter other than I kind of want to have a general idea of like an operating liability or an interest-bearing liability. So here's what I did down here. Levi's, first time I looked at their balance sheet was tonight, about 4 minutes before I start this. And they actually have all these accrued expenses. And so I just am going to call that total accrued liabilities, accrued expenses, whatever. If you have a better title for that, please use it. I'm not saying mine is perfect, but so what I did there is I just summed up, 3 accounts that were kind of related for each year. I could have actually added in more rows, but it's not going to change anything about my investment thesis, so I'm just going to move on. And I'm going to jump back to I like to do the working capital first because that's consistent with the way we talk about free cash flows to equity. It doesn't need to be done that way, but that is how I'm doing it. Let me jump to here. I got PP&E. Now for PP&E, I'm actually combining the right of use assets because that basically is PP&E. So it's like the assets they lease, and then they've got goodwill as well. I will copy that and throw that in there. And I think I got one more. Let me just make sure this works. Did I get everything? Still need this other. So they had intangibles. Let me show you this one again. They had 3. They had deferred taxes, other non-current assets, and intangibles. I'm going to put them all together. So I have my total other. Make sure I get that in there. And that is, I'll leave that title as is, actually. I called it other non-current operating assets. That's kind of what it is. It wouldn't actually matter if they're current or not here because it's just a random account anyway with lots of stuff in it. Importantly, it's complete. I've captured everything on the asset side of my balance sheet, but it doesn't really matter what I label that. Although, something, actually, I want to use some sort of other account just to make sure that's clear. All right, investments or excess cash. They did have some, although they're actually done. So this really won't matter because they're already to zero by that point. And I make a mistake every time. Good, but they're actually already to zero right there. So I mean, I can put that in. I'm going to put it in because I like completeness. But like that actually won't be a part of my model because it's going to be zero. I'm going to assume it's going to be zero. I have no reason to predict that. Okay, I'll keep going here. The what's their total debt? So their debt, I combined like interest bearing stuff, and that goes in my total debt. If you want to split this open, it's fine, but it won't make a difference. It's really not meaningful. I think I got those. I'm going to jump down here. All right, and then for my equity, oh wait, I've got multiple liabilities. Yes, they have all these other liabilities. So all their liabilities. That's why I made a note there. These are just going to all be here, and actually, I'll show you this. I'm going to put this in other liabilities up here. And why am I putting that back up with current? Well, because they're kind of a mix of current and non-current in terms of like when they're actually going to come due. I know they're classified as non-current, but that won't matter. Current or non-current, I'm going to argue these are kind of still related to their operations, so it doesn't make a difference if I put them in current or non-current. I put them in current, put them in other account, it won't matter. I've included them, but it doesn't change your valuation like the way you label things. I know that a lot of way valuation is commonly approached is all about labels and stickers and all that fun stuff, and that's a ton of fun, but that's not going to change anything that's meaningful to those of us who want to look at the company. So let's do this. I need to put in retained earnings. And that's this number here. There it is. And then I have this. Other controlled contributed capital. This is a great one to summarize. There are lots of different equity accounts, and what matters is you have the contributed capital. So I just combined everything else. So it's like basically everything other than retained earnings. I'm going to throw into that account. Getting close to be done, but I missed something. What did I miss? That's fun. The other long-term operating lease liabilities. Oh, so I have a mistake here. That is good to see and to fix. I should have actually included this. That needs to be there. And then I need to scroll this over. So good. I'm glad I will always make mistakes, so that's good. It doesn't balance, and my balance sheet doesn't balance yet. So I obviously missed something. Like there's no reason that should be the case, except, and if you do this, which I've done many times, like it just means you miss something, or maybe you actually double counted something. That could happen too. Or you put the wrong sign on something or something like that. But in this case, I actually just missed something. So I forgot to include my long-term operating lease liabilities as part of my debt. I just fixed my numbers here, just the total subtotal. And I need to plug them in over here at my debt. So I need to copy paste that. As you can see, look at that. Isn't that wonderful? Now my balance sheet balances. I do have this slight discrepancy here. My retained earnings check. I'm not going to cover that tonight, but it actually 638, 654, 199. I'll probably be able to solve that here, but I don't want to waste too much time there. Yeah, that's actually probably it. Yes, that's it. Sorry, I'm not actually. Whoop. Yeah, there's my amount. So the reason this is off is that I have other movement, obviously dividends, which are not built in my model, but then dividends and the repurchase of common stock. And if I put those two, that's what's going to work effectively like a dividend here. Let me actually show that title, sum total. I was playing around with this just to see if it was. I'll put it down here. I'm willing to bet if I subtract from that, it'll go away. Yep, did. All right. And I might be slightly off. That's fine. But sorry, I was not clear what I was doing. But often you might actually have a situation where when you're doing your retained earnings check, your retained earnings beginning balance plus net income minus dividends minus retained earnings ending balance equals zero. And that was the case here. The difference being that, actually, I want to be a stickler here. I want to get this right. It's not literally that number that I typed in. I want to get it to be actually zero. Wait, I did that wrong. That's not going to work. Sorry. The You'll have companies that have something that affects retained earnings other than just net income. The most common is dividends, but there are going to be other things as well. And so when you have that, I would just look at the easiest way to do it is to look at the statement of stockholders' equity. It's one we don't talk about, we don't analyze, but like if you're just trying to technically tie things out, you can use that to do it as I did here. It doesn't change anything except that you can make sure all your checks work out to be zero. So I just want to go through what I did. I got the information from the income statement and the balance sheet that I got from the SEC's webpage. I had to do some changes to titles. I had to do some organization of accounts, some subtotals. But I have effectively right now put in all of my data entry for Levi's for this particular period. Now, I haven't still done my valuation yet. I need to work on those. But I'm going to do that right now, and then I'll tie things out. What do I have here? And then I'm going to start messing around with my formulas. I'm not in any way saying these are right. Again, this is just me completing the process. And let's see what I have. Actually, I think I have another mistake here. Yeah, I have my shares outstanding are actually too high. That was just a data entry thing. I needed that there. Okay. Yeah, I was guessing why. Probably should have been closer. All right, let's do this. Now I need to do what? My goal is just to tie these out to the closed price. And the models are different because I didn't actually balance my balance sheet yet, but I have a general idea what I need to do. It's probably a little bit too high. So I'm not standing by any of these. I just want to walk out like, how do you make the valuation lower? Well, you just change revenues and expenses. So I am truly just randomly changing things. I want you to know. Well, I'm not. I'm changing them kind of knowing what I need to go to. And then I'm going to keep tweaking them just to get at it. Actually, I'll tweak the terminal periods because it makes my process different. And I'm only going to change operating expenses and revenue because, again, every honest conversation about valuation, and any conversation, people who understand valuation, that's what you're talking about anyway. So I'm still a little high. Like I'm eyeballing it because I didn't actually tie my stuff yet, but I still know I'm a little high. So I'm actually just going to have to do what? I have to like decrease revenue and sure, why not? I'm not standing by any of this stuff and I have to increase expenses, but I am just showing like, hey, what has to happen here? This is probably the one actually. I should have been messing with. Doesn't matter. These aren't meaningful in any way. I'm still high. I'm going to go back up and just change them again because I'm trying to tie it to the current price. I am not in any way standing behind these things. I think this actually may need to be like that. All right. So this is not real valuation, just mechanics. All right. I'm pretty darn close there. I'm going to work with this right now. So the current price was $20.97. I'm at $21.30. But I actually still need to tie out my balance sheet stuff, and I'm going to show you that as I move forward. So, all right, let's do this. Here's what I'm going to do here. You can actually, I would recommend, you can see some of my valuations. I've actually used this is not clear. I'm done with the Excel file from the SEC. So let me actually scroll this over and show you the whole thing. I don't want to make this too big. All right, so now we have this. Two plugs are this: additional investments. And I would plug that if like your argument is like they're going to kind of build up, they're not ready to pay out the dividends. They're going to build up a bit of marketable securities or financial assets and they'll eventually pay them out. Another one, which is the simplest way to do it, is just to argue that any excess cash generated could be distributed as a dividend. Now, importantly, you're not saying they literally will do this, but this is like the core idea of valuation is that how do we represent value created or wealth created? We do so via income. Right? That's the way that it is done. And then how do you represent what can you do with income and translate to cash flows? And then the cash flows can be distributed as dividends. But whether you use like a dividend discount model, a cash flow model, or residual income model, it's all actually always should be literally and exactly the same. And that's because like if you focus on the wealth creation, that's what's on the income statement, the wealth creation of a company, wealth created can be translated to cash, cash can be paid out. And in the end, for every company, they should be the same. Wealth created can be translated to cash, can be paid out. So I'm actually going to just make my plug equity, not because I think that's perfect, but because I'm just like shortcutting the process of if it's wealth created, it could be paid out. So that's like the wealth created could be paid out. The nice thing about equity is like you could use GoalSeek. I'll do the first one with GoalSeek, but then I'll show you if you're using equity, there's a simpler way to do it too. So data. What if? Oh man, it's fun because how slow I am around Excel and how fast you guys surely are. By changing cell. Good, I got 1 year done.
think I have a formula I need to fix there in a second. I'm going to hold off on that. And then the next year, I can just do it this way too, though. If you're doing equity, you can just plug those in. I think I have my wrong. Yeah, those formulas I need to update. I need to do that again for the other sheets too. That's a different issue. The what if analysis, I could do that again, or I could actually do, because equity is basically saying you're not earning anything on it, you might as well distribute it. The simpler way to do this, just to balance it out, which you still need to balance it out, is just, as you can see here, and you have to work in a linear fashion, like 1 year to the next, because it'll actually change. But all I'm really saying is like that, the misbalance is exactly what I would pay out in dividends, or like hypothetical dividends, or repurchase. It doesn't matter. And you'll see I'm actually control pasting the number, because there's like decimals here and I want it to literally tie out. So you know, all right. So don't just eyeball it, because you want to actually be exactly tied out. And to be clear, is there any, I am already have established that the wealth created could be distributed. I'm not saying that Levi's will be, or any company will be. It's just that they could. So it won't affect value. The wealth is created. That's, why is valuation a conversation on revenues and expenses? It's the wealth you create. It's independent of when you actually distribute it. So my balance sheet and my retained earnings check all work. Like my balance sheet balances, or you can see here, like my assets equal my liabilities, total assets equal liabilities for every single year. So my valuation, my balance sheet is now actually tied to everything else. And then this is the thing I want to show is that, hey, and guess what then? My free cash flow model, my residual income model perfectly tie out. That's a literal 0 to at least 16 decimal places. In fact, let's show that. I could do this. This doesn't look nice, but I could make this. Oh, wait, a different format anyway. If you go in there, that's like 0 to many places. So that's a literal 0 as represented there with the dash. My valuation model gave me a thing of $21.30. Let's just play around with it to make that slightly lower. How do I make that slightly lower? Well, I'll tell you how. I just need to increase an expense ever so slightly. Is there any rationale for what I'm doing? No, there's not. That's the whole point. I'm just trying to tie it out exactly to the valuation. Oh man, I'm so close. I'm 6 cents away. I'm going to go with that. But I still need to actually tie out my balance sheet, because I did one thing, but I only turned into terminal period. So it's like, I should have actually had an extra $13 in my what I could have paid out. So I'll just do this, delete that last one, take this, Control C, post that in there, post that in there, and then you'll see it works out. So I am done. I did that is my valuation for, well, you can't see it because I skipped over it. That's my valuation for Levi's. It took me about 20 minutes to do. It perfectly ties out. I have all my valuation built in there. I did not think about my forecast. I just randomly put stuff in here. I am not in any way saying I expect these to happen. Obviously, they're all like positive. It could happen. Like there are companies that have this. There are companies that have that. That's all I'm saying. But none of these are specifically in any way tied to Levi's. I have a discount rate. Sure, it's not a nonsense discount rate of 0 or 147. But I'm not saying that Levi's is 9.5. Maybe you have a great argument for being 8 or 12 or 13, or I don't know. It doesn't matter. You figure that out. But I just want to show you that you can create the model. You can come up with a value. My way of saying is like, if you give me I guess what it was 20 minutes, a set of financials and whatever stock price you want, I can tie out the model to it. And the nice thing is we can do it by just focusing on what matters. Even if they're not the real things, it still drives value. This is why it's a math conversation. What drives value? Any conversation about valuation, if those of us who understand and talk about valuation, is a conversation around revenues and expenses, and then obviously tied to assets, liabilities, and equity as well. So I'm done that. That's it. Let me do this if you really want. I'm going to do my Model 3. It's just a longer horizon. So here's how I'll do it. I'll just show you how I've been creating these. So yes, I've done all these, but it's not that nuts. I need to do this. I'm going to start with my framework for DraftKings, just because I know that it was done. I knew that it was done before that, where I'm not walking you through why that was. And then I need to just do this. I need to take my numbers for Levi's, the data I entered, and actually just copy paste it in there. Now, when I was doing these, sometimes I forget something and it screws it up. But I'm going to go through this and just do, this is like sensitivity analysis. Again, I'm not standing by any of this. I need to make sure I get all my stuff in here. So 2097, let's remember that together. And I want to copy this price here. Valuation of Levi's 3. What do I have here? I'm just copy pasting the shares outstanding, and then I remembered the share price, obviously, because this was DraftKings, so it wouldn't have been helpful there. It obviously does not tie out, but that's because I am not I'm not done. I still need to copy the rest of this stuff in here. So I need to put the Levi's number into my DraftKings model, and then I'll be good to go. So I think that's it. Let me just make sure I got where I started from. Cash equivalents. Put this down here. So I'm completing a whole second model. It's obviously way easier. This is why I'm hoping that you. Oh, I screwed up. I put it in the wrong spot. It needs to go there. That's okay. I use the undo key quite often. All this stuff works out. It's actually the same issue as before. I forget what that's over here. No, it was over here. 198.6. Okay, so I'll just do that for simplicity. Minus 198.6. All right. What? 198.6. 198.6. Okay, so now it works out too. I'm still not done because these are actually still my plug accounts I need it for DraftKings. I'm going to delete all these and just do the same thing. And then I'll show you actually how close we'll get once we're done this. So now let's just jump back up here. This is what's the difference with this model. I'm actually 2037, so I'm already pretty close, but I still want to finish it out. The difference with my model V3, version 3, that doesn't mean anything. It's just that I allowed the forecasting period to be longer than version 2. Terminal is always the same. You have 2 terminal years. Secondary, initial, tertiary, whatever you want, can be as long as you want. And I cover all the stuff in my valuation videos that I hope you've been able to watch at some time. So now I just need to tie out my balance sheet, and I'll have my second model done. Now, I mean, if you want, we want a different value. If you wanted to, let's just have fun with this one. So I'll do this. I'll get a value of around $40. I don't know. I don't know if I could come up with a value for them of 16 trillion, but let me just double the stock price. I'm not standing behind this. I just want to show you that you can make valuation whenever you want. It doesn't take a ton of time. So let's do that first. How do I double the stock price? Well, I'll tell you how. I increase my revenues, and I will get a wonderful way of showing how much higher the stock price is. Now, these are all, there are companies that these numbers are real for. I'm not saying that they will be for, all right, let's do this. And I don't change tax rates or financing or all those other little nitpicky things. A lot of other people do it. Hey, I got $50. All right, fine. I'm going to change it. I actually meant $50, not $40. But I'm not standing behind this. But naturally, if I change revenues and expenses, my value goes up. And if I decrease them, it goes down. So there's nothing interesting about that. That's just the math of valuation. Every conversation on valuation is a conversation on revenues and expenses, except I guess by the individuals who are trying to hide things. All right, so I'm going to do the exact same process and tie these out and just close it. This is making sure my models work. And also, why am I doing this? It'll help me identify if I have another mistake. So this isn't like the work. This is mindless. I'm talking to you and just sort of barely paying attention here. But I do like completing the process to make sure that I do have a completely articulated set of financial statements. I didn't yet talk about the statement of cash flows, but that's below, and I'll show you that. It's not related to valuation, right? I know that cash is how we count. Counting of cash is one way we think about valuation on the scoreboard, but the value is driven by what you're doing at your core business. So cash is just how we count it up. I still throw in a statement of cash flows here just for completeness if you want to see it. And I didn't cover that in the other model, but it would be exactly the same. So I just tied out my balance sheet. Let's see what I got. I'm hoping I have a strike around $50 a share. All right, good. I got $49.87. I'm going to quit there. That to me feels like $50. So I'm going to stop. Again, I'm not in any way. There's absolutely nothing here. All I'm showing you is the math of valuation. If you increase revenues and you decrease expenses, your value goes up. If you decrease them, value goes down. That's the math. That's the things that drive value if you're going to spend your time on them. But I'm not in any way saying I expect 12, 10%. I just made these numbers up because I wanted an end result. Let's jump down to the statement of cash flows just so you can see it. Again, I'm not saying this is the most visually appealing presentation, but hopefully it works. I just have my simplified statement of cash flows. You can see here it ties out. I'm just showing you that this is like my 3-statement model if I wanted to do it. Whether I do simplified, just meaning like fewer aggregated accounts, or if I do the full thing step by step, like on a specific statement of cash flows, I would still tie it out. Oh, I'm not going to fix this now. I actually know what I need to do on this one. I forgot about it. But the simpler one does try out. Sorry, I'll show you that again. This one ties out, and I forgot to do one more thing. I'm going to fix that before I save this for you, but not during this video. So that's it. That's the 3-statement model if you needed it, but you don't actually need to forecast cash flows. It could be, the nitpicky bookkeeping evaluation. You do need it to count, but it's not driving value. So I would spend all my time forecasting revenues and expenses, particularly operating expenses.
get my valuation and move forward. All right, I think that's it. I'm going to actually save this. I do have some minor things I need to tweak in the spreadsheet, but so you know, for all of you, we've got what across here? Let's go through this. I got my true blank one. If you really want to do this, do it on your own. There's your blank Excel for you. Then I have my blank version 2 where I just use like assets 1, 2, 3, 4, and I deleted everything. If you want to see this yourself, the template, I just cleaned it up a bit so there aren't the other numbers in there. The same thing here, expense 1, 2, 3, etc. That's blank version 3. Version 2, version 3, just different on the timeline. And then I did Reddit. I tied out to Fridays of last week's price. I don't know if it changed. Again, none of these, I'm not taking a personal opinion on any of these things, not the discount rates, not the tax rate, not the growth rates, not the expenses, none of them. I'm not taking an opinion on any of them. I'm just showing you how numbers work. Shake Shack, Wingstop, Boot, Boot Barn Holdings, and then Levi's. So we got our 6 companies there. They're paired together. And that's it. So let me save this. Let me end this video. Hopefully that was useful and not too slow for you. But those of you who are computer tech savvy, those kind of things, you'll have a ton of fun because I was able to do that whole thing, build a valuation model, talk about it, do a sensitivity, a whole second model in roughly a half hour. And some of you are going to be able to do this in 5 or 6 minutes because you're not, making all the mistakes that I made. Obviously, I have a little bit of comfort with the math evaluation and the core understanding of the business. That helps a little bit, but hopefully you've got that too by, obviously attending every class. Good luck. Have fun. You can post any questions.